Welcome to Stock Knowledge and News with Arieous Invest, your trusted source for updates, earnings reports, and actionable insights to sharpen your stock market game. Join us as we explore market trends, decode the latest news, and empower your financial journey with expert stock knowledge. This is Trading Reimagined. Let's get started.
All right, everybody, welcome back for another deep dive.
Yeah, glad to be back.
You know, I'm excited about this one because we're diving into something a little bit counterintuitive today.
Oh, do tell.
It's all about, well, you know how sometimes you see, like, really strong stock performance?
Right, those headlines that make you think everything's booming.
Exactly. But our source today is making us think a little deeper about that. They're saying that even when things look rosy on the surface, there could be some underlying market risks. Kind of like those hidden currents beneath a seemingly calm ocean.
Ah, I see where you're going with this. So how can investors, or really anyone who's paying attention, learn to spot those potential red flags? That's the million-dollar question, isn't it?
Well, let's try to find out. What jumps out at me is this idea of market overvaluation.
Right, and it's a bit tricky because it's not always obvious. You might have a handful of companies doing incredibly well.
Superstars, right?
Exactly. And their success can kind of skew how we perceive the entire market. You know, it's like that saying, a rising tide lifts all boats. But sometimes it's more like a rising tide that lifts a few yachts while the rest of us are stuck on rowboats.
Okay, I like that analogy. So are you saying those high-performing stocks can create a distorted picture of the overall market's health?
Absolutely. Think about it. If a few companies get really hyped up, their stock prices can skyrocket, even if the fundamentals of those companies aren't necessarily that strong. And that hype can spill over into the broader market, driving up overall valuations, even if most companies' earnings don't really justify those higher prices.
And that's where things can get a little scary, right? Like, what happens if those high flyers suddenly stumble?
Exactly. That's when you start to see those market corrections or even crashes that can really impact everyone's portfolios. Remember the dot-com bubble back in the late 90s and early 2000s?
Yeah, internet companies were all the rage.
Right. Everyone was pouring money into anything with a .com at the end of its name. But a lot of those companies were built on hype, not solid business models. And when the bubble burst, well, let's just say a lot of investors learned a hard lesson about overvaluation. The thing is, it's not just about individual companies. It's also about how those high flyers can affect index funds, which are often seen as the cornerstone of a diversified portfolio.
That's what I was thinking about earlier. You know, most people assume that index funds, which are supposed to track a specific market benchmark, like the S&P 500, are pretty well diversified.
And in theory, they are. But here's the catch. The weight of each company in an index fund is determined by its market capitalization. So if a few companies are doing exceptionally well, their stock prices go up, their market cap increases, and suddenly they represent a much larger portion of that index fund.
So my supposedly diversified index fund could end up being heavily reliant on the continued success of just a handful of companies. That doesn't sound very diversified anymore.
It's a bit of a paradox, isn't it? And it highlights why it's so important to really understand what's inside your index funds and how those benchmark weights can shift over time. You don't want to be caught off guard if those star performers start to falter.
Okay, so this is starting to make a lot of sense. Even when the market seems to be doing well overall, there can be these hidden risks lurking beneath the surface. But let's get practical for a second. What can investors actually do to protect themselves from these kinds of market distortions? I mean, diversification is great in theory, but how do we actually put it into practice, especially when it comes to navigating this overvaluation issue?
Well, the good news is there are quite a few strategies you can consider. One approach is to think beyond broad market index funds and explore sector-specific ETFs. These allow you to invest in particular industries that you believe are undervalued or poised for future growth.
So getting a bit more granular with our stock picks, huh? Not just relying on the overall market trends.
Exactly. Another strategy is to delve into the world of value investing. This approach focuses on companies with solid fundamentals, like strong earnings and good management, even if those companies might be temporarily out of favor with the market. They might not be the flashiest names, but they can offer long-term value.
Okay, those are some good starting points for stocks. But what about those alternative assets we hear so much about these days? Things like real estate, commodities, even things like cryptocurrencies.
Mm.
Are those worth considering as part of a diversified portfolio?
Absolutely. Alternative assets can be a great way to further diversify your portfolio because they tend to have different performance cycles than the stock market. For example, when stocks are struggling, real estate or commodities might be doing well, and vice versa.
Right, it's like that old saying, don't put all your eggs in one basket.
Mm,
But some of these alternative investments can seem a bit intimidating, especially for someone who's just starting out.
I understand that. But there are ways to gain exposure to these assets without having to, say, buy a rental property outright. For instance, you can invest in REITs, which are real estate investment trusts, or commodity ETFs. These provide a more accessible way to participate in those markets.
So there are definitely options out there for investors of all levels.
Yeah.
But it all comes back to this core idea: diversification, diversification, diversification. Even when things seem like they're going great in the market, it's crucial to be aware of those underlying risks and to make sure our portfolios are positioned to weather any potential storms.
Couldn't have said it better myself. So, to wrap things up, here's something for everyone to ponder. If history teaches us anything, it's that periods of concentrated gains in a few areas of the market are often followed by broader market corrections. So as we move forward, what signals should we be watching for in the coming months to make informed investment decisions? Are there specific economic indicators, industry trends, or even geopolitical events that might give us a clue about the direction of the market?
That's a great question to leave our listeners with. Thanks for joining us on this deep dive. It's been a fascinating conversation.
Absolutely. Always a pleasure.
And we'll see you next time.
See you then.
Arieous Invest. Trading reimagined.